Let me close something here. And I'm going to share my screen. I hope my audio is good. I understood from some people that the audio was bad, but I hope this is a little bit better. And I hope that everybody can see this as well. This is just a QR code to the book, Asia Stock Markets. And as Michael said, we're not going to talk about the technicalities of markets, price earnings ratios, profitability, cost of equity, and these sort of things. We're going to move all of that aside. But we're trying to understand how these markets work in Asia and what they can actually a little bit tell us and how they've come to be. What they can tell us about the region to a certain extent as well. I'm going to start actually a long time ago, on the 1st of April, 1602, to put a bit of a historical context in place, but also to actually illustrate a little bit how we should think about the stock market. And then we're going to later look at how they've performed and what makes the stock markets up and why that is the case. And at the very end, I actually would like to talk about some key kind of themes that run through Asia that is important from a stock market perspective. Well, we start off in my hometown, April the 1st, it's not a joke, in 1602. And on that evening, in a small alley in Amsterdam, actually the first shares were ever traded. What happened is, and I'm going to go to the next picture, this is Amsterdam a few years later, 1680. On the front here, you can see a few galleons or boats that were going off to what is now Indonesia and Asia and India and these sort of places to buy cloves and maize and all sorts of spices and bring them back to Europe. Now, the Dutch were rather unorganized kind of bunch in that particular trade. They were competing with the Portuguese, but the Dutch were not one country. They were actually all different cities that were setting up their own expeditions, people that came together, put some money together, got themselves a boat, got themselves a captain, got themselves a crew, sent them off, and then prayed for about 3 years, hoping that the ship would come back, wouldn't be wrecked, or they wouldn't be killed by pirates or whatever, come back with a lot of spices that they could sell at massive profits. Indeed, the Dutch cities then started to organize them, but the city of Amsterdam and the city of Enkhuizen or Hoorn and some of the other places, they started to compete amongst themselves. If there was a harbor, for example, in Banten, which is now West Java, where some of these ships arrived, and they blocked each other from coming in because they wanted to make sure that they could do the best trade and not the newcomer coming in, to the benefit of the Portuguese. So eventually the Dutch came together and said, this is ridiculous. We can't compete amongst ourselves. Let's put everything together. So they put everything together in a new company, and they said, okay, instead of basically you investing in one expedition, we will now combine all the expeditions together. And what we'll do is anybody who puts money into this venture, that was the Dutch East Indies Company, will get the profits for the next 21 years. I don't know why 21 years, and after 21 years, they continued anyway, so they're not so relevant in that sense. But they combined it all together, and they also said, and this is important, anybody who put money in, their name was written down. If you would go to a particular place in Amsterdam, you could actually, in the registers, say, I have sold my stake to so and such, and that would be registered in a large ledger. And the practice was that you could actually meet a buyer or a seller on the bridge. That bridge is actually in this painting as well. You can see it in the middle, and I'm going to zoom in a little bit. And you can see that bridge here as well. It's called the New Bridge. Funnily enough, it's still there. Of course, it's not in this particular condition. If you come out the central station in Amsterdam, you actually, after 50 meters, you're on a bridge. That is still the New Bridge. Anybody, most of you will live in the UK. Anybody who's ever been to Holland, the weather is just as bad. Waiting on a bridge in rainy and cold and windy weather is no fun. So eventually they went to the bars, but these bars got crowded as more and more trades took place. So they said, we need to have a building where we do this. And that was the stock exchange. They call it de beurs. And this is also on this picture. You can see that in the back on the left, the S is gone, but you can see de beurs is written there. That is the tower that was on top of that particular building. And that's where the trades took place. But the important thing here is that you had right to all the profits that were made or the profits that were divided, dividends, that came from all the expeditions in the course of the next, say, 20 years. In the beginning, as I said earlier on, that continued much further. That was the first stock exchange. And actually, the first trade took place on the 1st of April, 1602, in a small alley in Amsterdam. It's still there, you can visit it, but nothing happens there. Indeed, the oldest share certificate of the world is from that particular trade on 1602. You can see the front and the back cover here. The front is on the left. It's in Dutch, Old Dutch, but actually, if you're Dutch, you can actually read it. And basically says that somebody put 150 guilders in. That's probably the price of a small house in Amsterdam in those days. 150 guilders in that venture. And you can see on the next, on the right, dates. And those were the dates that he received dividends. He received something. Sometimes it was cash, and sometimes, in particular, I think in 1638, they literally received bags of pepper, mace, and stuff like that. So that was the first stock exchange. Turned out it was a good idea. The French took the idea over in I think it was 1620s or 30s. The British took it over in 1650, and before you know it, went to the US. And as Mike said, it was in around the 1880s, it arrived in Asia as well. The stock exchanges were set up. And now we're going to move fast forward in time and just look at the last couple of decades and put a little bit of contemporary history in place after the Second World War, if you want to put it like that. We had a couple of key events that will resonate or come back throughout this presentation. First of all, Taiwan and Korea after the Second World War and the Korean War, in particular with US help, started to set up all sorts of export sectors, in particular chemicals in the beginning, and electrical equipment. They did that very often in some kind of transfer of knowledge took place. So they started to learn how to make that stuff and eventually did it themselves. And some of these companies have really risen from that particular period to large giants at the moment. India was a bit different in the 70s and early 80s. We had a couple of people that came from some of the high quality universities there, spoke fluent English, had studied pharma and said, hey, we can actually make cheap medicine. It's something they come back and we'll get back to, but that's something that started in the 70s. In the 80s, everything was about Japan. So the Sony Walkman was taking over the world. So the Japanese stock market is as big as all the stock markets in the world together by the age of the 80s, and that then deflated thereafter. We had an Asian crisis in 97, 98. That's important, that comes back. That led to a reset, in particular in ASEAN. Y2K is indeed an important event for us as well. That was the fear that on the last second of 1999, as we would move into the first second of 2000, that all the clocks in computers would go haywire. So we needed software engineers to check out if that would really take place. Now, the world didn't implode at that particular point in time, so maybe the software engineers did a good job, I don't know. But very often these were Indian software companies that were involved with that. And a lot of companies later said, hey, these Indians are pretty good in some of that stuff. And it allowed for further growth in the IT sector there. A year later, we had China entering the WTO. It became an export nation, the workshop of the world, as they said. But yeah, you're talking about 6, 7 years later that a lot of people that worked in these workshops started to consume more. So the consumer economy started to blossom. And later on, and we'll talk a bit about that, all sorts of other industries started to emerge as well. And we see that progress of changes reflected in its stock markets as well. And of course, in the last couple of years, we've seen a growing antagonism and trade wars between the US and China. So these are some events that I just want to highlight because they will come back later on in the presentation. Just quickly on how to think about stock markets, there are two things of importance. One is what you get from the companies, that's the profits, or actually more exact, the dividends, and those bags of maize in the past, that's now just basically money or stock sometimes. But also because you get it over a period in time, it depends on, how you discount future payments. Because if I tell you you're going to get $1,000 right now, you'll be very happy. But if I tell you you're going to get $1,000 in about 100 years' time, you say, well, I'm not going to be around. You're not going to be around. So there's no value for me in that. So over time, as we go further into the future, we need to discount certain payments. And we do that, and that's actually something that the bond market does. So there are two things that are important: earnings growth in Asia, and it's actually been pretty okay. It's been around, say, 13% over the last couple of years. And bond yields, the discount rate, and that discount rate, as you can see on the right-hand side, has fallen over the years. And that means that, yeah, future payments have become more more valuable. And that means that with earnings growth and lower discounts, that actually the value of the stock market should have gone up. And that's exactly what has happened over the course of the last, say, 20 years or so. If you would have put money into Asian stock markets in 2000, on the 1st of January 2000, you would have had, these numbers are a bit outdated and the market is hovering all around, but it doesn't matter too much. You would have made about $510. Now, very often people then say, yeah, but if I put the money into the American stock markets, I would have made a little bit more money, 570, as you can see here. That's the S&P 500. And I'm going to tell you that that's right, but that is actually also wrong. But that I'll get back to that on it. Now, very quickly, what stock markets are we talking about? There's quite a few of them around. These are probably the key ones, and maybe also a little bit less, kind of on the fringes as well. But just look at the size of the bubbles here. It looks at the trading activity in these markets, and the size of these markets. The US is, of course, the biggest one. But if you put China and Hong Kong together, the two stock markets, it doesn't equal the US, but it's actually getting there. Japan is big. Taiwan and Korea are a bit smaller than India, but they trade more. So they are kind of the old ball, red ball out here. And then you have a whole range of markets that are much smaller: Thailand, Malaysia, Singapore, Indonesia, Vietnam, and the Philippines. And actually Bangladesh should be there as well in the next couple of years. They're all smaller, but if you group them all together, they're a reasonable bubble as well. So this is, broadly speaking, the universe that we're going to talk about. One last thing I'm going to talk about, but I'm not going to go into detail here, is that certain markets, they're not the same, and they look the same. The way they behave is pretty much the same. For example, the Korean stock exchange behaves very much like the American stock exchange, actually most so, while the Bangladeshi stock market doesn't behave whatsoever. So if the US stock market goes up overnight as we speak, most likely the Korean market will also go up. But with Bangladesh, we can't say anything. It might go up, it might go down. We don't know. So this is something that we'll get back to a little bit. If we think about Asian stock markets, and there's so many of them, we should probably break them into 4 blocks. You got a main block, I would say, that's mainland China, Hong Kong, maybe Singapore you can throw into there as well. Korea and Taiwan are two markets because of a kind of similar history, you could say, an export-led history. So we get back into that. We're going to look at ASEAN and we're going to look at India as well. And those two markets are actually very different again from China, Hong Kong, Korea, and Taiwan as well. And not just in size, but also in terms of the dynamics of these markets. So we're going to start with what we can call the central block. That's the ones around China. Now, this is a picture of me when I still had some hair. In 1990, I was a backpacker in Indonesia and in China. This is actually in Indonesia. But it was this picture was made a couple of days before I flew to Hong Kong. That place was a bit too expensive for me to stay, actually. So I went straight over the border into Shenzhen. In those days, there was no money, renminbi. Foreigners couldn't get renminbi, Chinese money. So I had traveler checks, went over the border, went to a bank, and then they would give you Chinese money for foreigners, because the deal in those days was that the vast majority of foreigners that would arrive for travel in China would be on a package tour, stayed in 4 or 5-star hotels, and would shop in friendship stores. Backpackers like myself couldn't stay in 4 or 5-star hotels. I just didn't have the money for that. Shopping in friendship stores was irrelevant for me. I needed noodles and bus tickets and stuff. So I needed local money. But at a bank, I would get Chinese money for foreigners called FEC, foreign exchange certificates. So the moment I walked out of the bank, a lot of Chinese came up to me because they wanted these FECs because you could use that to buy in Hong Kong TVs and all sorts of other stuff. Indeed, when I was sitting down for the first time after I came out of the bank, I put some money in my pouch that I had. Somebody said something to me. I looked up. The guy hit me on the nose, stole my money. So within my first half an hour in China, I had lost $125, or the equivalent of that in renminbi, and I had to go back and change money again. I needed money. The next time I came out of the bank, of course, I was much more careful. I walked away from a crowded place. People would come back to me, and the bigger the crowds I learned, the better I could negotiate. And I actually got a decent deal. My $100 I could exchange, instead of getting something like 800 renminbi, which was the official exchange rate, I could get something like maybe 1,000. So I could actually make a little bit of money out of that. So that was good for me. I didn't like Shenzhen at the point in time. It was a building pit, as far as I remember, all construction everywhere. Anyway, I'd just been hit on the nose. So I took a flight to Guilin. Turns out that flight had a problem. It ended up in the paddy fields. So by later that evening, I was half stuck in mud, having a bleeding nose, still blood on my t-shirt, lost $100. And I thought, maybe this is not a place where I should actually be. Something is going to go wrong here. And a man came up to me and told me, come with me, gave me some noodles, asked me where I wanted to go. I told him what my direction was. He put me in the bus. And after that, I continued to travel, had a fantastic time. But that's not so relevant for us. What is relevant for us here is that money inside China is different than the money that's outside of China. That means your interest rates inside China, your discount rate that we just spoke about earlier, that's so important, is different inside China than outside of China. Now it gets a bit complex here, because there are four, arguably five stock markets in China, or Chinese stock markets. You get the Shanghai market, by far the biggest one. We call that the A-share market. Within that, there's a particular market called the Star market. No need to talk about that. There's the Shenzhen Stock Exchange. There's mostly tech companies. And just recently, they put in Beijing as well, but it's so small, I haven't even put it here, so it's not so relevant. We're just going to look at Shanghai and Shenzhen here. That's inside China. And that's determined by discount rates in China, the money that flows around in China. Outside China, you got Hong Kong and ADRs. Why would companies go and list outside of China? Well, in the past, when China was starting to grow in the 70s and 80s and early 90s, companies needed money. So actually, in order to obtain money, a lot of the larger state-owned enterprises, they actually went to Hong Kong and tried to borrow or get money, not borrow, but issue shares. Those were called H shares, Hong Kong shares, in order to obtain money and expand. It was only after 1990 that the Shanghai Stock Exchange opened, and Shenzhen as well, that actually they could do it in Shanghai or Shenzhen. But yeah, even then it was a small market. So a lot of them had to go somewhere else. Hong Kong was a preferred destination. Later, for a lot of tech companies, they went to New York because that's an even bigger market. And yeah, tech was more common there as well. So a lot of them went into places like New York. But from 1990 onwards to 2000, 2005, Shanghai and Shenzhen quickly, rapidly developed. And as I mentioned earlier on, China had entered the WTO. So yeah, a lot of exporters were doing very well. So it was exporting companies that needed money to grow. And they went to either the Hong Kong or the Shanghai market. Sometimes even they listed shares in both markets. That can happen as well. The funny thing is, well, of course, that the same shares for the same company in Hong Kong and Shanghai can still move differently, because although the profits are the same, the amount of money that goes around these markets can differ. The discount rates, it can differ. Remember, it's profits and the discount rate that are the two forces that pull on stock markets, if you want to put it like that. So we call that an A or H share discount, if A shares and H shares actually move in the opposite direction. So yeah, that development in China, to a certain extent, is still being reflected in the nature of these stock markets there. How have these stock markets done? Well, here you can look, $100 invested 20 years ago, a little bit over 20 years ago. How much would it now be? You can see if you put in Shenzhen, you made most of your money, $700. So much more than the American market, which was $570, if you can remember. Shanghai also done very good, 668 has done better. And Hong Kong, which is called the Hang Seng China Enterprises, that's the H-share market I spoke about earlier, only $400, so not as good. So these markets have done very different. And why is that the case? Well, yes, the money that flows around in Shanghai and Shenzhen is different. I mentioned that as well, but also the makeup of these markets is very different. Look at the names of the companies that are in Hong Kong, the HSCEI, the Hang Seng China Enterprises universe, Meituan, Tencent, Alibaba, those are tech companies. If you look at Shanghai and Shenzhen, SSE on the right, Moutai, that's a liquor company, a bank, an insurance company, then a tech company, Green. But if you go below that, you got a travel company, a bank. So In Shanghai and Shenzhen, in particular in Shanghai, the bigger market in China, it's most kind of what we can call traditional companies that went there. But it was the tech companies and the exporting companies and the larger state-owned enterprises, China Mobile, and the banks that really went to Hong Kong over the last 20, 25 years or so. So the makeup of these markets is different. Therefore, the profits generated in these markets is different. And therefore, they can move around very differently as well. So if people ask me, what do you think about the Chinese stock market? I have to ask them, which one are you talking about? Because you can be positive on the Shanghai market, but negative on the Hong Kong market, or vice versa, in that sense. And then we haven't even spoken about Shenzhen or the ADRs, the companies that are listed in the US. And you can see that a little bit here as well. Very different makeup of these markets. Hang Seng being sort of the Hong Kong part, having many more tech companies. The Alibabas, the Tencent, and these sort of companies. So the dynamics of that market are therefore very, very different. And that means also the nature, how they move with the US market, if it goes up and down, differs as well. Actually, a lot of these markets, in particular Shenzhen, hardly is being impacted what happens with the US. And it makes sense because the money, as I said, that goes around in China is different from the money that goes around the rest of the world. We call that capital control. So they have a very low correlation. They don't really relate with each other very much. And that's a great advantage as an investor, because if the US market is bad, it could well be that Shenzhen or the China market does very well. And actually last year, that was the case, although the reverse, the US market did well and China not so good. But maybe this year it could be the reverse, China doing very well and the US not. These markets are not as much related. Now, there are a couple of issues, I'm not going to go into that, which it comes back to the tension between China and the US that forces Chinese companies in the US to relist somewhere else. They can go anywhere in the world, but the vast majority is going back to Hong Kong, actually. And that makes Hong Kong increasingly a kind of NASDAQ of the East, the tech market of the East, you could say. You see a transformation in this market from being primarily property, Hong Kong is a big property place, to really a tech market. And a market where this is taking place as well is Singapore, which is also part of that block, as I mentioned earlier on. Singapore is mostly bank and real estate, yet, but some tech companies, in particular Southeast Asian tech companies, are starting to list there. But that changes the nature of this market as well. I'm not going to go too deep into it. It's a big exporter, but look at the performance here of, in particular, Singapore over the last 20 years. $100, you would have made 275. That's about half of what the US has done. Remember, there was 570. So the Singapore has really dragged, you could say, Asian performance down, while Shanghai and Shenzhen have actually done much better than the US, as we saw in the previous chart. There is something very unique in Singapore, I must say, that I want to quickly highlight. That's what we call S-REITs. S-REITs are basically building blocks that are listed on the stock exchange. You can take a large building, buy it. If you're the owner, you issue stock, and anybody who buys that stock is then an owner of that building, and you can list that on the stock exchange. That's a real estate investment trust. Big stuff in Singapore. You can see that actually these companies have done very, very well. And also their performance is rather stable. It's something that investors in Asia very often look for if they look for stability in the market. Good. Now, having discussed that particular block, let's go to North Asia. And what we mentioned earlier on already is that in particular Korea, Taiwan, but also Japan in the 70s and 80s went on an export-led kind of growth model. They increasingly went for more sophisticated products that worked out very well. And that has had a major impact on how these stock markets actually behave in these days. So let's take a look at that. This is, by the way, a picture of a Japanese artist of the rice market in the, I think this is the 70s or 1800s, where some of the very first, what we call futures, trading on something that might happen in the future, you could say, is what was taking place. But that's not so relevant for us. Now, in the 80s, Japan was dominant. It grew phenomenally well. Sony's Walkman was a phenomenal product, but all sorts of other companies emerged. The stock market boomed. And in 1989, the Japanese stock market was bigger than all the stock markets in the world together. The US, Europe, you name it, you throw in whatever, it was bigger, massively big. It then deflated. It was overpriced. People had put way too much money into it, and that stock market came down. And if we then look at the performance of Japan over the last 20 years, it's actually not as good, almost as good as Singapore, a bit better than Singapore here. Because to a large extent in the early 2000s, it was still deflating after that bubble that it had in the late 90s. It was only after 2000, say 10 or 11, that that market started to recover again. So to a certain extent, this is not fair to Japan, I would say. But yeah, we've determined how have the stock markets done over the last 20 years. And Japan has not been one of the better performing ones here. But that's because there was an aftermath of that bubble that took place. Now, the Japanese market is all sorts of companies are listed in it. I would actually say there are three parts that are really interesting in Japan. First, you have the exporters that I mentioned on that started very small in the 50s and 60s, became bigger in the 70s and 80s, dominant, and really are now global kind of exporting companies, that your Toyota and auto companies and stuff like that. Then there is a group of companies that are simply smaller companies. Some of them become very big that are really good at making a particular product. Fanuc, the number 1, 2, 3, 4, 5 in this particular list, is an automation company, a robotics company is a good example of that. And then there is a lot of domestic companies that really focus on an aging society. Japan is the most aged society, not in Asia, but in the world. And therefore, there's all sorts of companies that deal with that and try to build products for an aged society and are probably leading in that regard. Now, I'm going to go straight here into Korea and Taiwan and not talk about some Japanese numbers there. But this is the makeup of the Korean Taiwanese market. Because they had this export-led sort of growth model, eventually they went into technology, and technology really drives these markets. So the underlying economy in Taiwan, particularly in Taiwan, is not relevant to the stock market. What happens with Taiwan economy is just not something that I even look at, because these tech companies in Japan, that's the case, but in particular in Korea and Taiwan, they sell their products everywhere around the planet. The US, China, and Europe are basically their biggest markets. Now, the makeup and the nature of these companies is very different though. See, let's look at the larger companies in Korea, the KOSPI index. Samsung, most people will know. Hynix, you might know, is a DRAM producer. If you go a little bit further, you get LG, of parts of the LG group. Hyundai Motor. I bet that most people could at least recognize one or two names here, LG being an electronics producer as well. In most cases, if you look at the Taiwanese name, TSMC, Taiwan Semiconductor Manufacturing, a lot of people wouldn't necessarily know that. MediaTek leader, Honhai. Well, Honhai is the one that makes your iPhones, and a lot of the other companies here as well. So both Korea and Taiwan have gone for the exporters, and these exporters have started to dominate the stock markets because as they needed to grow, they needed money. They went to the stock markets to raise that capital. But what is different in Japan, actually in Japan to a certain extent, but in Korea, sorry, what is different in Korea is that one, they've gone for the larger groups that do all sorts of businesses. LG and Samsung are large groups. Secondly, they've gone for global brands. If I would go and walk into a mid-sized town in England and I would say, do you know Samsung? The majority of people will know. If I tell them, have you ever heard of TSMC? The majority of people would know. The Taiwanese have gone a different direction. They haven't gone for brands. They don't operate in large groups. They're very often very laser focused on one particular product that they do very well, and they're very conservatively in the way they run these businesses. They try to be super efficient and very careful in terms of building out. The Koreans, they got a little bit more oomph. They've gone from tech into making TVs and into all sorts of other products, sometimes even ships and boats and cars and you name it. And as I said, have built those brands. And that changes the nature of these markets to a certain extent as well. And you can see, because they sell around the world, these markets are very much related to what happens in the US. If the US goes up, Korea in particular, but Taiwan as well, is very sensitive to that, because that is a barometer, you could say, for the strength of one of the largest economies in the world, that being the US. How have these markets done? Well, actually, they've done about as good as the US market as well over the last 20 years. So these markets have actually done very good, although a lot of that performance has come literally over the last few years or so. But that's because we need tech in all sorts of stuff. DRAM, which is memory, or you need chips. It was initially only in smartphones, but over time we have it in our TVs. We got it in our fridges, we got it in our cars, everywhere. And the electrification of the car also means that there's a lot of business for these companies to do. And now we're going to look at India and ASEAN. And there the story is completely different, actually. So let's start with India. This is a nice quote from a British economist. Everything they say about India is true, and so is the opposite. And that, in a sense, is true. India, this is an indication of a couple of demographic parameters: birth rates, female labor participation, marriage rates. It doesn't matter. It scatters over India, and this is important. In India, we already mentioned that in India, there are some really good universities, and some of these people in the university in the 70s said, hey, we have learned at university how to make medicines. We could take aspirin, we can make it cheaper. Actually, we can not only do it with aspirin, we can do it with all sorts of products. So a pharma industry started to emerge. Other people said, hey, we're good in kind of IT, and they proved the metal, they proved their worth at Y2K. A lot of companies went to them and said, you can help us out if our computer's going to crash. On the 1st of January 2000, turned out it wasn't really the case. Maybe the Indians, we have to thank them for that. I don't know, it doesn't matter. They had provide services, and a lot of these companies said, hey, you guys are pretty good in this. Can we do more businesses? So it led to a kind of unique pharma and IT sectors, growing as larger export sectors in India. But India has another story as well, and that is slow urbanization. Unlike in China, if you were born in West China and you had primary school, you could take a train to East China when China was this export-led growth model in the early 2000s and find a job in a factory and make a bit of money, very often 3 times as much as what you do in your village back home. So you made some decent money and you could send it back home. In Indonesia, you can do that as well. In India, that's much more difficult. Why? Language. If you were born in the southern part of India and you only get high school, or not very often, they don't even finish high school, and you don't have a good education, you speak Tamil. If you then go to, say, Mumbai or Gujarat, they speak either Maharashtrian or Gujarati or Hindi or English, languages that you don't speak. So in India, it's much more difficult to urbanize and go to these production centers and work in these factories there. Much more difficult than it is in China or Indonesia. So what we've seen in China is that a lot of people could be easily employed in the export sectors in the early 2000s. This is something that in India didn't really work. That's why we have this certain sectors, pharma and IT, that have done very well, but other sectors haven't really been able to do so. It also means that a lot of people still live in rural townships, rural areas. And that means you need to be able to get to these places in India, and that is incredibly difficult. Now, before I'm going to get back into this, but these are the top 10 companies in India. Now, you don't have to know them all. The more important chart is actually this. While Taiwan and Korea were pretty much tech markets, in India, you got large segments of financials, consumer, technology, healthcare, all sorts of stuff. It is the most diverse market, pretty much because you have these export sectors, but also a large domestic market. And that means that there's always something going on in the Indian stock market, you could say. If the export sectors don't do well, maybe the domestic sectors do pretty good. And if they don't really do good, it could well be that the export sectors actually perform very good, because there are all sorts of different dynamics at place. Now, but accessing these, and this is just a picture of rural India that turns out to be a tea plantation, but getting access to these people in those rural areas is incredibly difficult in India. Indeed, some of the global producers that have tried to do so have failed. Ford tried, didn't really work out. IKEA tried for years, it's very slow going. POSCO, a Korean steel company, has tried, has eventually pulled out as well. And that means it's very difficult to get into these markets. Hindustan Lever talks about winning in many Indias. They break up India in, I think it's 21 regions, and they actually treat it almost as a continent. The bureaucracy is sometimes incredibly difficult, but this is fantastic news. if you're already in India, because your competitors can't come in, and if you actually can distribute there, because that makes you become extremely profitable. Indeed, the most profitable companies in Asia are Indian consumer companies, the companies that sell soaps and or cigarettes or shampoos and stuff like that across the region. Now, I spoke about IT and pharma already. That also means that you get a kind of different dynamics in this market, one that offsets the other one. And this is important because if we then look at the overall performance of the Indian market, the Sensex index here, it has $100 would have turned into $962. That's almost twice as good as the US market. So if we go back to that statement I said at the beginning, hey, it looks like Asia hasn't done as good as the US. That's wrong because in a sense, there is not an Asia. India has done much better. Shenzhen has done much better. Shanghai has done much better. Hong Kong has been close to it. Korea and Taiwan have done about as good. But Singapore and Japan have really done much worse than the US market over the last 20 years. Is that diversity that we need to understand in the region. Now, lastly, on ASEAN, the story here, this is a picture of Jakarta in Central Java. The story here is that in ASEAN, I used to live in Jakarta, still actually in a sense, I'm going to be back there shortly. If you go from Jakarta to where my family lives, 25 years ago, it takes us hours to get there. Now there's a highway and it takes us about 3 hours to get there, much faster, because the infrastructure has been built out. We actually can easily travel around, in particular in Java. That means as a factory, you don't have to be close to Jakarta anymore. You can actually be in Central Java because you can get your trucks to the harbor in Surabaya. The infrastructure is much better. That means employment is being there now. So employment and growth and therefore consumer spending is broadening out in Indonesia. And not only that, Indonesians are really eager and happy to be online. So accessing this consumer has become increasingly important because they're outside of Jakarta, but also increasingly easy. And that's why these tech companies come up that in particular are listing actually in Singapore these days. It's still much banks and consumer companies, somewhat traditional, this particular market. But that's really the story in ASEAN, I would say. This Indonesian story is mirrored in the Philippines and Thailand as well. Although Thailand's got a lot of oil companies. Indonesia, you can see it's mostly financials, consumer goods, but you don't have a pharma, you don't have a tech sector like Korea has or pharma that India has in this particular market. It's really domestic stories that drive it here. And that means Indonesia, plays by its own tune. The US can do whatever it wants. Indonesia stock markets moves in a very different direction quite often. And therefore, the relationship it actually has, as we call it, correlation with the US market is much lower as well. And again, some of these markets in Indonesia over the last 20 years would have given you very good money. $100 would have turned into 772 in Indonesia, but you can see it's only 433 in Thailand. To an extent. So there's still divergence in performance here. Now I'm going to finish it off with a couple of things that run through this. One thing I've already talked about is the increasing antagonistic relationship between China and the US. What that means that in particular in China, but we see this actually in other countries as well, there is an increased focus, and you could say in Europe maybe now as well, on self-reliance in food, self-reliance in energy, and self-reliance in high-end tech, because China needs that and it cannot produce some of these things yet. It's the Korean, the US, and the Taiwanese that produce the most advanced chips, not the Chinese yet. So they're trying to catch up, and a lot of policies are being put in place in order to stimulate that. Indeed, you could argue that, for example, last year when a lot of regulations came out that hit the internet sector in China, the Tencents, the Alibabas, these sort of companies, it was maybe a forced reallocation of money towards those sectors that you want to invest in. Again, food, energy, and high-end tech. And with energy, they're reliant. You would think China would be chock full with gas and oil, but it doesn't have enough. It needs to go to the Middle East to get it. And that is a strategic weakness for them, which is one of the reasons why China is trying to build out solar and wind and nuclear power quite rapidly. So this focus on self-sufficiency is something that drives these stock markets. But in India, we see this as well. India's got big pharma. It needs to get its key pharmaceutical ingredients from China. It is trying to develop this as well. So what we see in the rest of the world is we're seeing in Asia as well, focus on being self-sufficient. Another interesting development, in particular, I would say in China, is demographics. China is unique in a couple of ways. First of all, it had a one-child policy, so that means households are small. If you had a household, it's typically 2 or 3 people, but let's say 3, 1 child. Secondly, people are aging. That means that the children are aging as well, and very often the children are leaving home. Therefore, the average Chinese is close to 40 now. Between 40 and 50, we've seen that the children leave. You go from 3 to a household of 2 persons. And a household of 2 persons spends very differently. It also wants to redecorate the house very differently. People in their 40s, 50s, and towards their 60s, they're looking more for experiences. They don't go and buy a new car. They got a car already. They don't buy a new apartment. They got that already as well. In addition to that, a lot of women work. So these 2 people where the child is gone, these empty nesters, they have very often a dual income situation. They're actually pretty well off. That group of Chinese empty nesters is probably one of the largest, fastest growing demographic and consumer markets on the planet at the moment. And again, what do these people buy? They buy home improvement. They go, it's middle-aged men in lycra, as they jokingly say. They go sports. They buy sports shoes. They want to stay fit. They go travel, domestic travel mostly at the moment, and these sort of things. And that's where they spend on. And we see that in performance in stock markets as well, because yeah, the companies that do provide those services do, of course, very well. In addition to that, as China ages, and we see this in Japan, Korea, and Taiwan already, yeah, they need to start to prepare for an extended period in retirement. There are no pension systems. People put money away on their own. They have to save on their own. Pension systems are put in place, but for a lot of people, they're still insufficient. And what that means is that they invest that property, gold, crypto, but also into the stock market. So we see lots and lots of Asians putting money into stock markets as well. They've actually became the dominant investor in Asia, while until say 5, 6 years ago, the dominant investor was actually the global fund, the pension fund that comes from the UK, Europe, the US, or elsewhere. But that's not the case anymore. And a third theme that goes through this is that there is growth that is either related to new cities or getting access to consumers in non-traditional areas, if you want to put it like that, outside of the larger cities, in the more rural areas, both in Java, as we spoke about it, as well as in India. And it's important to understand, in particular in the context of what happens in the world in these days, that if you invest in Asia, that's important to understand that there are these structural trends, demographics, the growth of Chinese empty nesters, growth in mid-tier cities in ASEAN or India, growth in industries that in particular China sees as they want to be self-sufficient, because that growth is to a certain extent very insensitive to what happens in other parts of the world and what happens with economies and the uncertainty that we face in markets these days. No, that's it. I just want to highlight 1 or 2 things. If you're interested in Asia, there is a free lunch. There's a free publication. It's sponsored by HSBC, but it's not done by HSBC, called Week in China. It's a great thing to get in order just to stay in tune what happens there. So it's a separate magazine, but HSBC basically carries the cost of it. I wanted to highlight that in case you're interested. There's a QR code. The book, to a large extent, what we've spoken about is in the book. If you're interested, you can get that here in the QR code as well. And lastly, if you're interested to learn more about Asian stock markets, you can follow me on LinkedIn. And we, as HSBC, regularly post there in order to provide updates. And that's you can easily find me there as well. And with that, I think I've stick reasonably well to my allotted, say, give or take 40 minutes or so. And I'm going to give it back to Michael here.
Herald, thank you very much indeed for that. And apologies to those who had difficulty with the sound quality from me at the beginning of this talk. I've put my headphones on and I hope that that's improving it. Herald, I'd like to start with, there's 1 bit of Asia that you haven't mentioned at all. And perhaps it's outside your scope, but Central Asian markets, the newly independent states in Central Asia recognized pretty early on in their independence the importance of establishing stock exchanges and did, but they have not really grown since then, at least certainly not by comparison with some of their peers in other parts of Asia. And Nicholas Edwards asks if you are able to comment on why that is.
Yeah, so that's right. I mean, we don't actively look at the Azerbaijan stock market, but we have the same in parts of the region that typically we look at, where markets look at. Sri Lanka, for example, has a very small stock market as well. There are probably a couple of reasons for it. Sometimes in certain countries or economies, there's a preference for bank loans instead of going over borrowing on the stock market. Actually, in Europe, this for a long time was the case, much less so in the US, for example. So that could be a case. That's an institutional arrangement that is there. But most often, it is simply a stock market is basically a channel between savers and investors, companies that need money and people that want to invest it. And if you don't have a lot of savers or foreigners who can invest in these markets, or companies that need that money, you end up with a very narrow stock market. The Sri Lankan stock market, for a long period of time, it starts to build out a little bit now, was basically just one large company that did a lot of different stuff, and that was it. But so it was with Vietnam. Vietnam in the 90s was a market nobody looked at, or early 2000s. It started to get onto people's radar screens. Now, for a variety of reasons that we can't go in, we can go in here, but we don't have the time to. There was a bit of a crisis, things overheated, all things went wrong in the market in all sorts of different places. But it was in the last 5 or 6 years that because of outsourcing going to Vietnam, you had more and more companies that were listing there because of outsourcing to Vietnam, production facilities were set up. People got a job there in a factory. They started to buy in a consumer market, in say, a convenience store. Well, in the past, they would be at home and cook themselves. Now they buy ready-made meals. So that company that makes ready-made meals suddenly starts to grow. It needs to expand. It goes to the stock market. Meanwhile, that guy who's got a job, he's saving as well, putting money in the stock market as well through a mutual fund or a pension fund that he's subscribed through, maybe with his company. So you can see that the channeling then suddenly starts. And what we've seen in Vietnam, that suddenly it gets to a critical level whereby foreigners say, hey, I can actually trade here now as well. The larger funds can say, I can actually trade in this market as well. And then suddenly it can grow. So sometimes it needs to go over a threshold in order to get that momentum and to be interested to larger funds around the region as well. You gradually have to grow there. And in certain markets, if you're below that, you just get stuck a little bit. An interesting market, by the way, just to highlight here, is a market that's on the fringes here, but I suspect in the next 10 years will propel itself as an interesting market is Bangladesh. It's a market few people look at the moment, but I suspect in 10 years' time, it will go over that threshold and be very good. The problem may be, and I don't know, I'm not an expert on the Central Asian markets, is that I don't know what the biggest companies there are. They could be oil companies, and people say, well, if I buy an oil company, I can get that anywhere else as well. So there's nothing too unique in these markets in that sense that makes them attractive immediately as well.
That's very interesting. Thank you. A different sort of question, because it's not geographical, but Joseph Richardson asks whether there's a discernible difference across the Asian markets you've been talking about in attitudes to risk, and if so, what is it? How does it play out?
Yes, very interesting and difficult question actually, but there is. What I mentioned earlier on is that until maybe 5-6 years ago, in the vast majority of Asian markets, the biggest investor was actually the global investor, the pension fund from the UK or Europe or the US, people that have a pension fund, put their money partially in a global equities fund, and that global equities funds invest part of that in Asia. Though that money, let's call it global savings, those were the buyers in Asian stock markets. What we've seen in Asia over the course of the last, in particular last decade, the last 5 years, and in particular last 2 or 3 years, is that the Asian retailer, Asians have in many markets have become sufficiently wealthy to put a significant amount of money themselves in stock markets. So they drive that now. So the risk profile, in a sense, has changed from being foreign, you could say, to regional. This is important for one or two reasons. First of all, in the past, if there was a crisis in, let's say, a country way outside of Asia, Argentina, people in New York or London would say, oh, we have a problem in Argentina. Let's sell emerging markets. There was risk across emerging markets. That's the way we look at it. But if the biggest investor in, say, the Indonesian stock market sees that things are really bad in Argentina, he doesn't think about selling Indonesian equities, unlike what this foreign would do. So in a sense, it creates stability. On the other hand, the risk profile can be quite different as well. In a sense, they are more willing to take risk. They go very often deeper into markets and smaller mid caps as well. And a really interesting thing as well developing is, and we see this with the Korean elections now, is that because the local investors become dominant in the stock markets, the politicians believe the stock market is becoming important as well. Politicians are always important. They always look at housing markets because their voters are house buyers, but there are also no buyers of stocks. So the performance of the Korean stock market has become a political issue in the Korean elections over the last few weeks. The Koreans ask themselves, why are we always trading at a discount to the rest of the region? It's not something we've spoken about, but that's the case. And there's a variety of reasons for that. It could well be that we see policies being implemented in Asia to address some of these issues, structural issues in stock markets, particularly in Korea. So that risk profile, that risk attitude is changing in many ways because different players and the different way the politicians are looking at this as well.
Very interesting. And we've got lots of questions coming in. Thank you, audience. Please keep them coming. We have a question now about Taiwan. Our questioner asks, could you provide a bit of color on the growing geopolitical tensions in Taiwan? To what extent do you think this risk could spread throughout the region? What would be the major triggers to monitor? Just before you answer that, I'll say on Monday we had a panel discussion about the impact across Asia of the Ukraine crisis. There's been a lot of speculation, of course, about whether what is happening there might embolden China to adopt a military solution to the Taiwan problem. Those who were there would have heard Professor Kerry Brown saying that actually he thinks the likelihood is that the Ukraine crisis is having the opposite effect on Chinese policy in two respects. First, of course, Taiwan as a military operation would be an amphibious operation, not a land operation. That's much harder to conduct. But secondly, what we're seeing in Ukraine is how difficult it can get for an invading country if there is a resolute resistance from a sizable population. And you know, from his perspective, at least, the risk, if there was one, of a direct military intervention by China in Taiwan is going down as a result of what's happening at the moment. But anyway, over to you.
We see that in markets as well. So first of all, stock markets are very bad in pricing political risk. We're very good in crunching financial numbers, really bad in geopolitical risk. Very often we take a binary kind of approach. If it doesn't happen, we don't really price it in. And if it happens, we suddenly do price it in. But generally speaking, and also in the conversations that I have with HSBC clients, is that it's perceived that that risk is lower. Now, there's a way of looking at this because there are Taiwanese companies that trade in the US. They have stock listed in the US and also in Taiwan. You could see if there would be a difference, for example, in trading there, or maybe if Taiwan would trade at a discount to the rest of the region because there was a higher perceived risk. That is not the case. So the stock markets at the moment say it is not an immediate risk. That risk is generally believed, in accordance to what your webcast was, have fallen to a certain extent, but it's not a risk that we should ignore. What we do see, and again, TSMC is a great example. It's the foremost producer of computer chips around the world. They used to be operating out of Taiwan. What they're doing now, they're setting up facilities in the US and using Taiwan to service the Chinese counterpart, because in many industries we see that industries are breaking up in blocks. You see a US Western block, if you want to put it like that, and a Chinese block, if you want to put it like that. Sometimes in certain industries, different standards are being used. So they need to cater for that. So their business strategy has to adapt for that as well.
And finally, I think, because we are almost out of time, Alice Wang asks, what has been your experience and what are your current expectations? What happens when oil is very high and the US dollar is very strong? I guess that is where we are at the moment.
Yeah. So oil being very high is not good for Asia. In a sense, in the 70s, the increase in the oil price means that you get, not in the 70s always, you get that money goes from people that buy oil to money to the people that sell oil, very simply. But in the 70s, the people that sold oil in the Middle East were savers. So global consumption went down. So it led to stagflation in the 70s, meaning low growth, high prices, inflation. Now, this is a bit different. You see that, again, it goes from the sellers of oil to the from the buyers of oil to sellers of gold. The ones who sell oil will make more money now, but they are consumers. So you see a shift in consumption, not a reduction in consumption. The problem is that Asia, to a large extent, is a buyer of oil, and particularly India is very sensitive to this. So it's not good for Asia. And if growth weakens in the rest of the world, it's not good for Asia, of course, either. Maybe the advantage is that Asia just had a weak year last year, so we will still grow. We won't go quickly like China in a recession or so. China's just come out and said that GDP growth will be somewhere 5.5% or so. So there's the recession risk or further fall off in growth is probably less so in China than it is, of course, in Europe. But, and this comes back to the themes that I spoke about. The good thing in Asian stock markets is that there are particular growth areas, so demographics, aging, the empty nester story, China's continued focus on self-reliance in strategically important industries such as semiconductors, as well as growing in those mid-tier cities in, say, Indonesia and India. Those are trends that will not be impacted by what happens in the US. Simply aging, I can guarantee you tomorrow, whatever happens, both of us, we will be a day older. So that will simply continue. And it is these sort of things that people need to look at if you're really into stock markets in order to find pockets of growth and ideas to invest in these very difficult times. Because what of course happens at the moment, higher oil, geopolitical risk, weaker growth is absolutely not good for stock markets. And we've seen that stock markets have come off to a very large extent to reflect that reality.
Thank you very much indeed. And we are going to have to close it there, I'm afraid. Just before we do, I should say, if anyone has been inspired to go in search of a copy of Herald's book in light of what you've been hearing today, I have posted a link in the chat channel that will take you to Blackwell's. I did a quick bit of research while Herald was talking, and Blackwell's seem to be undercutting Amazon at the moment. So whether the Asian book markets are following that or not, I couldn't say. We meet again on the 23rd of March when we have the next talk in our series, Culture, Conflict and Recovery in Asia. The subject is the restoration of the Aleppo souk, which you may recall was destroyed in a bombing campaign in a rather similar fashion to what is currently going on in Ukraine. Our speaker will be Ali Ismail, the head of the Aga Khan Cultural Service in Syria. Please join us then. For now, I would like to thank Herald van der Linde for a fascinating talk and a very different perspective on the economies of Asia. And until next time, goodbye.
Thank you very much. Have a good evening. Bye-bye.